Welcome to the deep dive. If you've ever felt like navigating financial news is like trying to cross a surging river, constantly fighting the current,
Yeah, I can definitely feel that way sometimes.
well, you've come to the right place. Our mission today is to be your guides, helping you find that solid ground, turning, a torrent of information into clear, actionable insights.
Exactly.
We're about to plunge into the fascinating and pretty turbulent trading week of June 14th to June 21st, 2025.
A really pivotal week.
That week was truly defined by some immense forces, wasn't it? We saw this striking divergence in central bank policy, escalating geopolitical risks,
Big time.
and this decisive pivot in the market toward what folks are calling a stagflationary mindset. We've actually got a comprehensive report here dissecting the most critical events from that period.
And our goal for you today is really to pull out the important nuggets of knowledge from that whole whirlwind week.
Right.
It's not just about what happened, but really understanding why it mattered and what strategic lessons you can take away. This deep dive should help you grasp the real impact these events had and how they kind of collectively reshaped the whole global financial landscape.
Well, let's jump into it then. The anchor event of the week, the one that really set the tone for everything else.
Yeah.
That had to be the Federal Reserve.
No question. On June 18th, the FOMC, the Federal Open Market Committee, they did hold interest rates steady. That part was largely expected.
Okay.
But the real shock, the thing that fundamentally altered how people saw risk, came from their updated summary of economic projections.
Oh, the SE.
Exactly. The Fed actually lowered its 2025 GDP growth forecast, cut it from 1.7% down to 1.4%.
Lower growth. Okay.
While at the same time raising its core PCE inflation forecast, that's, personal consumption expenditures minus food and energy, from 2.8% up to 3.1%.
Wow. So lower growth and higher inflation expected. That's conflicting.
It really is. And what's fascinating is that the dot plot, where each member puts their rate forecast, it still pointed towards 2 rate cuts for 2025.
Still, even with higher inflation.
Yes, but, and this is key, the number of members expecting no cuts this year actually went up. And the median rate expectation for 2026 was revised higher too. Then Chairman Powell's press conference just reinforced that hawkish feel, specifically calling out risks from tariffs and persistent inflation.
So definitely a clear yet conflicting signal. Less growth, more inflation concern. What did that actually do to the market? It sounds confusing.
Oh, it triggered a classic market whipsaw. Think of a rubber band snapping back and forth violently.
Okay.
So, for instance, your USD, it initially plunged maybe 80 pips on those first hawkish headlines.
Down hard.
But then, during Powell's press conference, it just violently reversed, rallied right back up.
Whoa.
It wasn't a clear trend at all. It was just chaotic volatility. And order flow analysis later confirmed a big short squeeze.
Ah, so people betting against the dollar got caught.
Exactly. Speculators had built up a record net short position in the U.S. dollar, nearly $17 billion short in the week leading up to the meeting. They got squeezed out.
Ouch. A textbook trap, then, for anyone trying to trade directionally. What's the fundamental lesson for you here from that kind of mixed message?
This meeting, it really marked the Fed's sort of official nod towards a potential stagflationary environment, low growth, high inflation.
Right.
And the crucial lesson is, when a central bank sends such conflicting signals, hawkish on inflation but bearish on growth, the main market reaction isn't a clean trend. It's just massive volatility.
So trying to pick a direction is tough.
Extremely tough. Strategies focused on volatility itself, or maybe mean reversion, the idea that prices snap back to an average, they were far more effective than trying to chase a clear direction that week.
Okay, so if the Fed was setting this really complex, almost confusing new narrative,
Yeah.
how did other major central banks fit in? Did they follow suit? Let's look at the Swiss National Bank.
Right, the SNB. On June 19th, they cut their policy rate to 0.0%. Now, this was widely expected.
Why was that?
Primarily because inflation was falling. It actually went negative in May, and the Swiss franc, the CHF, had been persistently strong. They even kind of left the door open for going back to negative rates.
So very dovish from the SNB. Did the market react much this time?
Surprisingly, no. Post-event volatility was extremely low. USD CHF barely budged, moved in a tight, 0.4% range.
Huh. So why so quiet?
It was a classic priced-in event. The market already knew it was coming.
Got it.
The real lesson here, though, is how a currency's fundamental role, like the Swiss franc being a safe haven, can totally dominate interest rates when uncertainty is high.
So the safe haven status trumped the rate cut.
Completely. It was a case of sell the rumor, do nothing on the fact. The move had already happened.
Interesting. Okay, and across the channel in the UK, what was the Bank of England up to?
The BOE, they held their rate on June 19th, but, and this was telling, the decision came with a very dovish 6-3 vote split.
3 members voted for a cut.
Exactly. 3 members actually wanted a 25 basis point cut right then. That signaled some clear internal divisions. And even though they acknowledged the labor market was loosening up a bit, they were still worried about sticky inflation. The market reaction was immediate pricing in about an 80% chance of an August rate cut.
So a dovish signal. Did the pound take a dive then?
Well, interestingly, no, not aggressively. GBP-USD volatility was, moderate, contained.
Why not, if they signaled cuts were coming?
The pound's resilience wasn't really about its own strength. It was more about the bigger picture, the overarching weakness in the U.S. dollar.
Back to the Fed's message.
Exactly. The dollar was being sold off because of those global growth fears that the Fed's stagflationary forecast had kicked off.
It's really fascinating how interlinked all these decisions are. It's never just one central bank acting alone, is it?
Never. This just highlights why intermarket analysis is absolutely essential. The BOE's decision wasn't in a vacuum. It was the BOE relative to the Fed.
Right.
The Fed's message on June 18th truly set the compass heading for all the major G10 currency pairs for the rest of that week.
Okay, one more major player. Japan. The Bank of Japan has been the outlier for so long. What do they signal? Still sticking to their guns.
Pretty much. On June 17th, the BOJ held its policy rate at 0.5%. They did announce a plan to taper their government bond purchases.
Some tightening.
Well, sort of, but the pace was much slower than some people had hoped for. Just a reduction of $200 billion per quarter, and not even starting until fiscal 2026.
That's very gradual.
Extremely gradual.
Yeah.
And Governor Ueda's press conference was notably cautious, just kept emphasizing global uncertainties.
So more the same slow, super cautious approach we've come to expect.
Precisely. This decision just reinforced expectations that their ultra-loose policy is going to continue, and it basically cemented the Japanese yen, the JPY, as the funding currency of choice for carry trades.
Meaning borrowing cheap yen to invest elsewhere.
Exactly. So any strength you see in the yen based on, rumors of them suddenly turning hawkish, you should probably view that as a selling opportunity, frankly.
Okay, so central banks were pulling in different directions, all under the Fed's shadow. But then things got even wilder, right? Geopolitics threw a massive wrench in the works.
Oh, yeah. This is where it got really dicey. We saw a huge spike in geopolitical risk on June 19th and 20th. Reports started flying about Israeli strikes on Iranian nuclear facilities and the potential for direct U.S. military involvement. That immediately triggered a classic risk-off wave. Sell risky things, buy safe things.
Okay, so markets panicked. And then what happened? Did it stick?
Well, tensions cooled off surprisingly quickly after President Trump announced a 2-week grace period for diplomacy.
Yeah.
And that reversed a lot of the initial panic selling. But that period, that was easily the week's most volatile event in terms of just raw price swings.
How volatile are we talking?
The VIX index, the market's fear gauge, surged above 22. WTI crude oil prices jumped as much as 13% at one point before pulling back.
Wow, 13%.
Yeah. And safe haven currencies like the yen and the Swiss franc, they rallied hard. USD/JPY dropped significantly. And gold. Gold soared above $3,400 an ounce.
Gold doing its job as a safe haven then.
Absolutely. And benefiting from the higher oil price inflation fears, too.
Yeah, that sounds like an absolute roller coaster. What's the practical takeaway from that kind of whipsaw for us watching?
Well, first, trading geopolitical headlines is extremely risky. It's really best left to very nimble, experienced traders with super fast reflexes.
Okay, not for the faint of heart.
Definitely not. For most people, the key takeaway is probably to reduce your leverage or maybe hedge your positions during periods like that. Just lower your risk.
Makes sense.
The most reliable trade during that specific flare-up was probably buying gold. It had that double benefit, safe haven demand, and the inflationary kick from oil.
Right.
And that rapid reversal when the diplomatic news hit, that just showed a clear sell the rumor, buy the fact dynamic playing out. React first, then reassess when the facts change.
Okay, so we've covered diverging central banks, chaotic geopolitics. What about the actual economic data that came out during the week? Did it offer any clarity or did it just add to the noise?
It largely seemed to confirm that shifting narrative towards stagflation.
How so?
Well, on June 20th, UK retail sales for May came out and they were a shocker. plummeted by 2.7% month over month.
Wow, that's a big drop.
Huge, way worse than forecasts, and the steepest fall since December 2023. That really intensified recession fears in the UK and pretty much solidified those bets on a Bank of England rate cut in August.
Okay, so bad news from UK consumers. What about UK inflation itself?
On June 18th, the UK's CPI data for May, it came in at 3.4% year over year. That matched expectations.
So no surprise there.
Not really, but it was still well above the baby's 2% target. And importantly, core inflation only eased slightly, and services inflation was still stubbornly high.
So not much relief for the beat.
Exactly. It was kind of a non-event for the market because it just confirmed what everyone already knew. Inflation's still a problem for the UK, and the BOE is stuck in a difficult spot.
Right. Not every big data point moves the market if it's expected.
Especially when it just confirms the existing story.
What about data from the US? Any surprises there that shifted the needle?
There was an interesting one on June 17th. The headline, U.S. retail sales figure for May, actually showed a decline that initially caused a bit of alarm.
Okay, weakness there too.
Well, here's the thing. The crucial control group component, that's the part that feeds directly into GDP calculations, it actually rose by 0.4%, beating forecasts.
So the headline was misleading.
Classic case of a misleading headline. The market's initial negative reaction faded pretty quickly once traders looked at the stronger underlying details. So ultimately, it was kind of a non-event for the US dollar.
So the lesson there for our listeners is definitely don't just trade the headline number. You got to dig deeper.
Absolutely. Never trade only the headline. The pros, the algorithms, they parse the details instantly, and that control group data, it's far more important for the GDP outlook than volatile stuff like auto or gas sales.
Good point. And finally, on the U.S. data front, what did the Philly Fed Index tell us about manufacturing?
Right, the Philly Fed. On June 20th, it stayed in contractionary territory, came in at mega 4.0. That was weaker than expected.
Still shrinking then.
Yes. And critically, the employment subindex, which measures manufacturing jobs, fell to its lowest level since May 2020, back near the start of the pandemic.
Ouch.
So this data point, coming right after the FOMC had put stagflation on the table, the market interpreted it as confirmation of the stag part of the Fed's outlook, the slowing growth.
So it didn't boost hopes for rate cuts?
No, quite the opposite. It actually weighed on risk sentiment, reinforced those growth fears.
Okay, so we've covered the majors. But beyond them, there's always valuable information in watching emerging markets, right? They can be a kind of canary in the coal mine for global risk appetite. What was happening with the State Bank of Vietnam?
That's a great point. Yes, throughout that week, the State Bank of Vietnam, the SBV, was very actively managing its exchange rate, the USD-VND.
What were they doing?
They kept adjusting their reference rate, basically responding to pressure from the volatile global U.S. dollar and also the risks from potential U.S. tariff policies. The result was the Vietnamese dong, the VND, continued to depreciate, hit new lows.
Now, this might not be a pair most of our listeners are trading directly. So why is it important for us to track this? What does it tell us about the bigger picture?
It's really a textbook example of the challenges an emerging market central bank faces in times like these. The SBV is essentially forced into allowing a managed depreciation.
Why forced?
To preserve their foreign exchange reserves and also to maintain their export competitiveness, especially with those tariff risks hanging over them.
Got it. So it's a defensive move.
Exactly. And while you might not trade USD-VND, watching it is crucial. It acts as a barometer for EM health and overall global risk appetite. A weakening dong, for instance, is a pretty clear signal of risk-averse sentiment spreading through the whole ASEAN region.
Like watching a smaller tributary to understand the flow of the main river.
That's a perfect analogy.
Okay, so pulling all these different threads together, now the Fed's big shift, the other central banks reacting, the geopolitical shockwaves, the confirming economic data. What does this all boil down to for you, our listener, looking ahead? This week clearly set a significant new macro narrative.
Absolutely. That 1-2 punch, the FOMC's stagflationary forecast, followed immediately by the U.S.-Iran tensions flaring up that combo, created the most significant volatility and truly reshaped the whole macro story.
Looking back at that week, what were some of the most common mistakes or pitfalls that traders fell into that maybe we can all learn from?
Yeah, the report we looked at highlighted 3 key errors that kept cropping up. First, trading the headline, not the details. Like we saw with the U.S. retail sales, selling the dollar on the weak headline number without seeing the stronger control group underneath. Classic trap.
Right, dig deep. Right.
Second, trading central banks in a vacuum. trying to figure out the BOE or the SNB without putting it in the context of the Fed's overriding message. That was a critical mistake that week. All roads really led back to the Fed.
Everything was relative to the U.S. outlook.
Pretty much. And third, chasing geopolitical news. Trying to trade every single headline flicker on the U.S.-Iran situation, that was just a recipe for getting whipsawed by incredibly fast, often contradictory news flow.
Yeah, sounds impossible to keep up with profitably.
Very, very difficult.
So the market definitely learned some hard lessons that week. What are the key strategic takeaways for you, the listener, as you think about your own understanding, maybe your portfolio, moving forward from this?
I think the most critical insight, the biggest shift, is the need to adopt a bad news is bad news framework.
Explain that. What does that mean?
Well, for a long time, there was this idea that bad economic data was actually good for markets, right? Because it meant the Fed would likely step in with rate cuts to save the day.
A Fed put idea.
Exactly.
Yeah.
But the June 18th FOMC meeting, that marked a critical regime shift. With the Fed now signaling real concern about inflation even as growth slows, their hands are kind of tied. So now, weak data isn't a signal for imminent rescue. It's correctly interpreted as just bad news. A negative sign for risk appetite, for growth. You absolutely have to recalibrate your reflexes on this.
That's a huge shift in thinking.
It really is. Second key takeaway. Reevaluate the U.S. dollar as potentially range-bound.
Meaning not necessarily trending strongly up or down.
Right. It seems caught in this tug of war. On one hand, you have supportive interest rate differentials because the Fed isn't cutting aggressively.
Okay.
But on the other hand, you have this negative growth, this stagflationary outlook weighing on it.
Okay.
That push and pull suggests that maybe range trading strategies on the dollar index could be more effective than trying to chase a clear directional trend right now.
Interesting. Play the boundaries rather than betting on a breakout.
Potentially, yes. And finally, be cautious on commodity currencies. Think Aussie dollar, Canadian dollar, Kiwi dollar.
Why cautious there?
A slowing global growth outlook, which that week seemed to confirm, is a direct headwind for these currencies that are sensitive to the global economic cycle.
Right. They depend on global growth.
They do. So rallies in these currencies should probably be viewed with some skepticism. They might not last. However,
Yes.
the continued dovishness we saw from the Bank of Japan and the Swiss National Bank means the JPY and the CHF likely remain attractive funding currencies for carry trades.
So borrowing cheap yen or francs still makes sense.
It can, but with a big caveat. Given those geopolitical risks that can flare up any time, those positions should be managed really cautiously, maybe even hedged with something like gold.
Good point. Manage the risk. Well, we hope this deep dive has given you a fresh perspective on just how interconnected global markets really are.
Yeah, how central bank signals, geopolitics, economic data, it all weaves together into this complex but hopefully understandable tapestry.
It's crucial to remember, too, that markets are always evolving, aren't they?
Constantly. That bad news is bad news regime shift we talked about. It's such a powerful example of how the underlying story, the narrative, can fundamentally change how the market interprets the exact same piece of information. It's never static.
Indeed. So as you continue to navigate these often choppy waters of global economics and finance, maybe consider this. That era where bad economic data was somehow seen as good for markets, it seems, for now at least, to be behind us. How will you recalibrate your own understanding of these critical market signals moving forward?